So is it better to invest your money in quality dividend stocks or the S&P 500? This video is a response to some great feedback I got in the comments section for my previous video about the power of dividend investing, where we took a model portfolio of 5 stocks and we looked at what happened when you invest month over month into these dividend stocks over a period of 25 years and 35 years when you reinvest the dividends and when you don't, and we saw some spectacular results. So in this video, we are gonna take that model portfolio, the exact same one, the exact same assumptions, and we're gonna throw it up against the S&P 500, and we're gonna see which one comes out ahead. Is it better to invest in quality dividend stocks or the S&P 500? Let's go. Hey guys, before we get started, make sure to hit that subscribe button below the video to ensure you do not miss any future videos I post. Make sure to leave a comment below saying you subscribed, and I promise to respond personally to your comment. All right, so let's go ahead and jump right into the content, guys. You guys know I hate to waste a single moment of your time. We're looking at our model portfolio from the previous video, 5 different dividend stocks, and those dividend stocks are Walgreen Boots Alliance, WBA, Realty Income Corporation, O, First of Long Island Corporation, FLIC, UGI Corporation, UGI, and the McDonald's Corporation, MCD. And for the purposes of this video, we definitely wanted to capture the actual real 25-year history of the S&P 500. And the only S&P 500 exchange traded fund that worked for us was the SPDR S&P 500 ETF Trust. Ticker symbol is SPY. By far, it's the most common and well-known S&P 500 index fund. It does have a little bit higher expense ratio at 0.09% compared to VOO for Vanguard or utilizing FXAIX. But trust me when I tell you that the results from an expense ratio were not gonna make a difference here in this scenario. So before we get started, I'm gonna stop right now and say, stop what you're doing, go down to the comments section and let me know with a comment who's gonna come out ahead. Is it the S&P 500 or is it gonna be quality dividend stocks? So just like before, we're working with the same assumptions. For the S&P 500, we're gonna contribute all $400 to this specific investment, whereas with the model portfolio, we're contributing 20% to each of the 5 different dividend stocks, so $80 per each stock. And then every year, we're gonna increase the contribution for both investments by 3%. Again, we're using the actual performance history every single month for both SPY, the S&P 500 ETF, as well as the quality dividend stocks. Again, as you can see, this took a long time to build. So if you find some value, if you appreciate the work that went into it, make sure to hit that like button and subscribe if you have not done it. We like to give you quality content every single video. Trust me guys, you're really gonna wanna stick around all the way to the end of the video for this one here, because I'm gonna give you some initial results, which might surprise you, and then there's a huge twist that's really gonna blow everything out of the water. So make sure to stick around to the end. All right, so let's start with what actually would have happened over the past 25 years from December 1994 through January 2021. So here's what would have happened after 25 real actual years not reinvesting the dividends. For the S&P 500, we would have 1,378 shares owned, total dividends paid during that time frame, $13,000. Annual dividend income after 25 years would be $7,756. And the total holding value would be $520,702.60. How does that compare to the model portfolio? The model portfolio would have paid out dividends of $157,320. The annual dividend income after 25 years would be $17,044.83. And the holding value would actually be lower in this case, $494,589.40. Again, this is using the actual dividends paid out over those 25 years, the actual price changes. This is real life what would have happened. Again, not reinvesting the dividends though. So I guess you could say the S&P 500 won for that period when we were not reinvesting the dividends. But then again, who would actually do that? Who would not reinvest their dividends if they were investing over 25 years? How does the scenario change if we reinvest our dividends during that 25-year time frame? For the S&P 500, shares owned would be a lot more, 1,823 shares, total dividends paid 82,000 versus 13,000. Annual dividend income would be higher at 10,178 versus 7,756, and the total holding value would be higher at $688,585.73. How does that compare to the model portfolio? Boom! Model portfolio would have dividends paid $252,095.09. Annual dividend income $30,934. $1,000,000.14, and the holding value $880,363.38. Shut the front door. Model portfolio blows away the S&P 500 when we're reinvesting dividends. Now, to be fair, from a dividend income perspective, it won both scenarios, but even with the holding value, how much the portfolio was worth, it blew it away if you reinvest the dividends. The expense ratio wouldn't have much of a factor here between 0.09% for SPY and 0.03% for VOO. It's just the truth of the matter is it's a better result when you reinvest the dividends. Now the big question becomes, what happens after 10 additional years of investing in these two different options, the S&P 500 and the model portfolio, based on some hypothetical assumptions we make? To be specific here, the assumptions we're gonna make are, for the price history, we took the actual monthly changes over those 25 years, so whatever, 25 years times 12 months, a lot of different months. We averaged out the pluses, the minuses, and that average came out to 0.77% increase every single month. So we applied that for those 10 years. Every month, the price was 0.77% higher. Now I know that's not real life because we know that there are ups and downs in the market, but there's just no way to truly replicate that in a model like this. We just assume that it was a straight line increase based on that average increase of 0.77% every month. Again, that's the actual S&P 500 monthly changes for the past 25 years. And then for the dividend growth rate, we had to apply a hypothetical assumption here too. So we took the actual dividend payouts for the previous 25 years with SPY, and we decided to take an average there, and we applied that average to the remaining 10 years. For your awareness and for complete transparency, that average increase every single year came out to 6.47%. So what would have happened over 35 years investing in the S&P 500 but not reinvesting dividends? You would own 1,594 shares. Total dividends paid during the period would be $223,923. Annual dividend income at this point would be $19,987.60, and the total holding value would be $1.65 million, which is a great number. No one's disputing that. But the question in this whole video is not if it's a good number or not, but what's the better solution for the average Joe investor out there? You can see for the model portfolio, not reinvesting dividends for those 35 years, we'd come up with an answer of $461,000 in dividends paid. Annual dividend income would be $38,998.87, and the holding value would be $1.03 million. So we can see here that the dividend income is a lot better. It's double the S&P 500, but the total holding value again lags the S&P 500, 1.03 million versus 1.65 million. Let's see what happens if we reinvest dividends over those 35 years. We can see here for the S&P 500, we would own 2,377.89 shares. Total dividends paid would be $303,828.92. Annual dividend income would be much higher, $29,623.52. And the total holding value would be $2.47 million. Again, remembering in all of these scenarios, we were assuming that the first year we invested would be $400 a month, and then we would increase that amount by 3% every single year. This is what would happen with the S&P 500. So then what would happen with the model portfolio? We had dividends paid of $920,000 over that period. Annual dividend income would be $96,359.54, and the total holding value would be $2.54 million. So again, we've got a holding value that just ekes out the S&P 500, but the total annual dividend income that's being put off by that portfolio at $96,359 is 3 times what you would be earning with the S&P 500, which means that you could live off of $96,000 and never touch your principal, whereas most people, I believe, would have to start touching the principal for that S&P 500, and that would slowly bring down not only the actual value of the portfolio, but also the amount of annual dividends that would come off because you're selling parts of that portfolio. And here's where the real twist comes in, guys. Make sure to leave a comment below letting me know that you made it to the real twist of the plot. I was thinking to myself, I really thought that the dividend portfolio was gonna do better than it did. I had a strong feeling it was gonna outperform the S&P 500, but I thought the holding value would be higher as well than what the actual results showed. But then I remembered something. I remembered that for the model portfolio for those 5 stocks, I had assumed a straight line increase in the value of these stocks of just 5% a year, which was actually pretty conservative. Whereas with the S&P 500, what I actually did was look at the actual price history over those 25 years, take a monthly average, and then apply that for the next 10 years. So I decided to do the same thing to the model portfolio. I went into each one of these individual stocks. I looked at the actual price history over every month for 25 years, took an average of the price increases or decreases for those months, and then I applied that price history to those 10 years and the results changed. For those 35 actual years, not reinvesting dividends, the model portfolio now has total dividends paid of $457,374. The annual dividend income was $37,996.09, which is actually a small decrease from using the straight line of 5% price appreciation. It went down by about $1,000 annually. And then the holding value though went up to 1.7 million from 1.03 million. Significant increase there if we go with the actual price appreciation for those 5 different dividend stocks. And just for full awareness and transparency, for Walgreens Boots Alliance, the price appreciation on average was 0.16% increase every single month. That actually resulted in a lower overall portfolio value for Walgreens Boots Alliance, but increasing the dividend income. For Realty Income Corporation, it was actually 0.798%, much higher than Walgreens Boots Alliance. And so that significantly increased the portfolio value for Realty Income and lowered the dividend income every year, because those dividends being paid out would be reinvested at higher prices. For First of Long Island Corporation, the actual price appreciation every month was 0.8696% every single month. For UGI Corporation, the price increase every month on average was 0.8384%, which increased the value of the holding but lowered the dividend income. And then for McDonald's Corporation, the price increase every month was an average of 1.03%, and that definitely increased the holding value for McDonald's and lowered the dividend income being received. So even not reinvesting dividends over that 35-year time frame, the model portfolio of quality dividend stocks doubled the annual dividend income and was worth more money after 35 years. Oh my goodness, can you believe what would happen after 35 years of reinvesting the dividends? I'm really excited to show you this because this is really where the true power comes in, guys. This is why quality dividend stocks are so amazing. All right, for total dividends paid, we have $892,293.78. For annual dividend income, we have $88,231.51, which is nearly triple the S&P 500. And for total holding value, this number, I promise you guys, you're gonna be shocked by this. 2.4 million when reinvesting with the S&P 500. With the model portfolio, you ready for this? $3.95 million. I don't know what else I can tell you guys here. Quality dividend stocks that increase their dividend every year, that you reinvest those dividends, they just completely blow away the S&P 500 here. Oh man, I'm like on such a high showing you guys this data. Data, real life, actual facts tell you that you gotta go with quality dividend stocks. Now again, I don't have a crystal ball. I made some hypothetical assumptions here with what happened with those 5 stocks and the S&P 500 based on what's happened in the past. The next 10 years could be crazy, I don't know. But guys, if it's anything like what happened in the past 25 years, then you gotta go with quality dividend stocks. You guys know that I have my own dividend portfolio of stocks that I'm investing in for the future. You guys know I'm not just here spouting random stuff on YouTube and not following my own advice. I practice what I preach here. I have dividend stocks that I own. I know there's arguments out there saying that it's better to invest in dividend ETFs versus quality individual dividend stocks. So we're gonna test that. We're gonna see what this model portfolio does against those dividend exchange traded funds. If you haven't done it yet, make sure to hit that like button below if you found some value out of this video, and make sure to hit that subscribe button to make sure you don't miss any future videos here on the Average Joe Investor channel. That's all I got for you guys. Have a great rest of your day, and please continue to stay healthy, both physically and financially. Have a good one.